The topic of our next panel is called the value of specialist managers in a portfolio. Obviously, Typhon is very big on that, that we've got 15 portfolio managers, many who are sector specialists. Bernie, one of our panelists, County Cork, they run a similar multi-manager specialty model. Tom Mayer from Ferry is an avowed sector specialist fan. Mike Dubin is just about to launch his Dorset Commodity Natural Resources Fund that's focused on sector specialists. And Everest Bibari is a new portfolio manager at Typhon who is a systematic energy manager running the Valbona energy system. And Everest, I give you a special thank you. He is here even though his wife is about to go into labor. So that's the kind of professionalism we salute here. But with that, I'm going to hand the panel off to Mike Dubin. He is our discussion leader, so he is going to walk us through the topic today and weigh in. So Mike, take it away.
All right, thanks very much. So we have quite an impressive panel here. Couple of doctorates, University of Chicago MBA, few Harvard degrees, other Ivies. So we should have a fun discussion. We're fortunate to have different perspectives. We have Thomas Meyer, who's obviously looking at portfolios from a very broad spectrum. I'm a more focused allocator, and Bernie, you've been an allocator and a specialist manager yourself right now. So we'll be looking at this from both perspectives. And Everest, well, you have the advantage of doing everything if you're working for James. Obviously, you're not only a manager, but you're probably taking over the business. So we're gonna try to hit some new areas. Not just all the standard business about specialized managers being non-correlated and niche, et cetera. I'd like to take a look at this from both the investor perspective and from the manager perspective, because we have both of those people in the audience. And from the investor perspective, we'll try to get to what's hot, how do you find these guys, how do you evaluate them, how do you follow them, and from the manager perspective, perhaps you guys can tell other managers how, as a specialist manager, you try to get yourself allocated to. How do you approach the investor side? I thought we could just have 2 minutes each from each one of you. Start with you, Thomas, just to give a very brief background on your role, limited to 2 minutes, and then we'll move on to the questions. Thomas, you start.
Thank you, Michael. I hope my voice is clearly audible.
Yes.
Perfect. Yeah, my name is Thomas Meyer. I work for Ferry Trust in Germany, and we are an institutional asset manager and consultant, mainly for a classical German-speaking region for institutions like pension funds and insurance companies. We manage roughly $40 billion US, mostly in traditional assets, but we are also well known for our alternative investment division. There we have roughly 6 billion in private equity, some in derivative strategies, and over 1 billion in hedge funds all over the world. We have actually a focus on specialist managers because we believe that actually being a specialist and expert in his own field is actually the core of being able to generate alpha, which we are actually looking for when doing hedge fund investments. And yeah, so far to my introduction. I will come back later onto the questions you have asked.
Yeah. Okay. Bernie, why don't you give a little perspective from your point of view? Because you've been both an allocator with your multi-manager specialty and you're a specialist manager. Just give a brief overview, Bernie.
Thanks, Mike. So briefly, over the course of the last, say, 30-some years, I've been a trader on Wall Street, running a pop group, and then I started a fund, a sector specialist fund, that basically focused on allocating to fundamental discretionary managers in the hard and soft commodity space. And I did that for about 4 years, and in that process, I've kind of transitioned over to County Cork, and I help one of the programs in terms of execution and assistant in trading. And on top of that, I market the strategies that we run here at County Cork.
Okay. And Everest, you've been in many different positions in the natural gas and commodity sector. Give us what's it like to work with James?
I just recently joined Typhon, and so far so good. I have good
in a
things to
while.
So I run the Valbona energy system here at Typhon. It's a natural gas focused systematic strategy based on fundamentals. So we use purely supply and demand factors for the natural gas market, and we run a purely systematic strategy on the front of the futures curve. Before this, I was running the same strategy at a gas-focused fund, and before that, I was a head of strategy in one of the large natural gas funds in the U.S. focusing on North American natural gas.
Okay. And from Dorset's point of view, we're currently about to start a commingled product that allocates exclusively to discretionary commodity specialists who had backgrounds in the physical markets, but trade only in futures, everything through separately managed accounts. So it'll be a highly liquid, multi-strategy portfolio of 20 plus specialist traders. But we also are in parallel working on a product that involves leading edge quant CTAs, primarily to trade in the Chinese commodity markets. And then multi-manager approach, and I've been mostly in the futures business for most of my career. Well, let's start and I think shift over back to you, Thomas. Just give us you mentioned that you're very interested in the specialized manager, and so apart from being niche and uncorrelated, how do you look at the value of the specialized manager, and how does your investment committee categorize them? You have a separate bucket, or you just have a specialized manager in each one of the major asset classes? How does your oversight look?
Yeah. So what we do is, as we are proud of having a relatively large hedge fund selection team, we have dedicated analysts for each of the hedge fund styles. And regarding the hedge fund styles, I might have to explain that with hedge fund styles, we really see the main four categories: relative value, event-driven, equity hedge, and tactical trading. Whereas when we talk about strategies, we dig a little bit deeper and sometimes refer to them as sub-strategies, which could be, for example, convertible arbitrage within relative value, or equity market neutral within equity hedge. So, but for each of those four hedge fund styles, we have dedicated analysts, and those guys are the specialists in their field, although they obviously cannot really say be specialists in every sub-strategy, but they are focused on the certain strategies, and they should be able to challenge the specialist managers at least to a certain degree when it comes to the selection of those managers. So it's the task of those analysts to build up, so to say, a pipeline of managers in the respective strategies. This is what they do and how we work. So broad classification styles, then subcategories, and obviously within these sub-strategies, you can differentiate even more and find the real niche players, for example, regarding the exact asset class or the geographical allocation. We actually tend to allocate to the extreme specialists if possible. We do not shy away from, for example, smallish managers because their whole investment universe is relatively small. But as I already said, our focus is really on this value creation through manager skill and this old and maybe non-reputable word like alpha creation. So we want to create further value by selection of the fund and by the final exposure we get with them. And this can, in our opinion, only be done by really allocating to niche and specialist manager rather than to, say, global managers being able to or not being able to really focus on a certain niche.
Okay. It jumps to another area, but given the size of your overall allocations, can you actually work with a manager that has a capacity of 50 million?
Yes, actually, that's actually true. That's a good question. So obviously, there we have two different types of clients. Some clients, they demand more liquidity and have a preference for the larger managers. In this regard, we do not really differ from any other larger institutional hedge fund investor as well. But nonetheless, we have the ability, especially for the smallish to mid-sized mandates, to be extremely flexible in this regard and actually to allocate to smallish managers. Having said this, we actually run a program which we call acceleration program. And by acceleration, we mean something between seeding and normal investing. So this is really bringing young and small managers over certain limits in the assets under management. For example, 50 million or 100 million assets under management is such a limit where we demand then a type of cost reduction or even a revenue share from them to allocate for us to allocate and to bring them over this limit and to make this investment more attractive to other investors. Because as we all know, the industry just works like this. 100 million is a certain limit. Once you have reached that, asset gathering is much more easy than it was to come to those 100 million.
Okay, very interesting. So Everest, from the point of view of a manager, when you're giving your pitch to an investor, and for some of the managers that are out there listening, how do you emphasize, the advantage of having yourself as a specialist as opposed to a more generalist approach? What do you pitch?
So the idea of being focused, like Thomas was mentioning before, the idea of being focused on a specific asset class or sub-asset class is that you know more about that asset than probably anyone else. Your added value or your edge is alpha creation. So in my case, for example, I focus on natural gas. Natural gas is not really a niche market. It's the second largest energy market in North America. So we don't have a capacity limitation in that sense, but it has a lot of data that you have to be aware of. And with the amount of data, you also have to spend a lot of time on it, which makes being focused through natural gas an edge. So in that sense, what I try to take advantage of is the perfect imperfections of the market. So natural gas is based on the idea of seasonality, weather seasonality, and that's what I try to take advantage of. And those are the opportunities that are supposed to make money. So my edge is that I'm not reliant on how the market moves. So I'm not long only or short only. I take advantage of both sides. So it's all about alpha creation. And given that I'm focused on natural gas, I have a lot more knowledge about all the data that is available out there compared to a tourist in the market that comes in for a few days and allocates to it because it just popped up on somebody's screen. So in that sense, I have the ability to create alpha in all kinds of markets, whether it's going down a lot or it's going up a lot, and essentially every year as well. So the performance should be positive every year and uncorrelated to any other market in that sense. Okay.
Well, actually, let's come to you, Bernie. Let's transition to the subject of the edge and how we identify the edge. In our business, in allocating to discretionary managers, we look for two key things. One is that the discretionary manager has an edge from the ongoing context on the physical market. So it's just not a data monitoring system watching just the futures or the prices, but actually extracts information from the knowledge of what the underlying participants are doing And then the second key criteria is that they've shown the ability to actually make money off of that knowledge in the past. You have to have both. Now, Bernie, you've been on both sides of the business and still are as a specialist manager, trying to show what your edge is, and you've been an allocator in your Meech Lake program to the traders. How do you identify what are some of the key criteria for identifying an edge in a manager, particularly in the discretionary sector?
Well, there's managers that have better access to supply side issues, and then managers that have better access to demand side issues. So say, for example, in the agriculture space, do you have connections not only within the United States, but do you have connections in terms of better buyers, better sellers, that sort of thing? Are we able to move more product because of different circumstances on that side? So that's one thing. It's either a demand specialist or a supply specialist. It's hard for people to be both. Most of the people in, say, the agriculture space, like, because we produce more than pretty much most other countries in the world, we tend to focus on the supply side. We're much more worried about weather. We're much more worried about storage capacity, that sort of thing. And we hope the demand side holds true. But there's other times when the demand side is really the driving force. Like the China example right now. How much do they need? How much do they have? That sort of thing. Then there's another way of viewing a specialist manager. Instead of going to like a sector specific, but if they have a specialty, say for example, one of our programs manages the basis relationships of products, and we run that basis relationship across basically hard commodities that we can identify that there has a basis relationship. And we run that particular relationship across those specific products that have that positive basis relationship that might tie into futures price movements. So that is a different kind of a scenario than when we're just looking at sector specialists like our agriculture program or the natural gas program or something like that. But yet that's still a specialty. In other words, they don't trade any different styles. They just trade one particular style and they work that particular trade.
Okay, that reflects pretty much our approach as well. We like to have specialists that are focused on one area only. We get a little bit nervous when somebody like Everest, if you were decided you wanted to start trading copper, what really edge do you have, even though it might make sense for you to be a little more diversified? We want people to stick to their knitting and focus on the area that they know well. So Thomas, back on the edge. So you have the advantage of having quite a large team of specialists. If you take it from the point of view of a portfolio manager that doesn't have the depth of individual specialists in each one of these areas, I mean, how can one CIO know enough about natural gas trading or life settlements, or how would you advise an allocator who's more broadly based to approach the specialist area?
That is actually difficult. The simple answer to this question is, I think just one CIO cannot be a specialist in all these parts of the business landscape, of the investment landscape. It's just impossible. So it's actually completely necessary to hire a consultant who helps this CIO you've spoken about to do the allocation. And in this regard, I want to touch on what Bernie has said regarding the ability of some managers to do and being a real expert, a single strategy expert. I think there are two components of that. So first, when it comes to manager selection, it's obviously that you have to be a kind of a quasi semi-expert when trying to challenge the best manager in a certain strategy. So you really have to try to be as competent, although this never works fully to 100%, but try to really challenge the fund manager in order to see whether this fund manager is better than probably another fund manager who's doing the same strategy. But at the same time, you also should go one step back and see, is this whole investment space you're looking at really a space, a scope where you really could find an edge at all? So for us, for example, it's not possible really to find an edge for currency managers, because currencies are just a very efficient asset class. So probably there is no edge for none of them. So it's as simple as I say, it's sometimes very difficult to really identify any edge in an asset class. Another thing is when you look at, for example, global equity hedge managers doing equity hedge analysis in the large cap universe, one has to question oneself, is there an edge at all? Can there be an edge for a manager, or is it just futile to really seek an edge there? Might it be better to really allocate to, say, the large cap global equity market by an ETF without hiring a specialist managers? So to make this long answer very short, I think you have to really be aware where there could be an edge at all. And when you identify that there could be an edge, then you really should seek either outside consultancy as a CIO, or really try to identify those managers being experts in this field at all. In our opinion, in many spaces, in many investment spaces, I already mentioned two, currency trading or global large cap equity hedge, there might be the case that there is no edge at all, and we should really focus on cases where we could identify some edge at all, which might be in more illiquid or less traded asset classes.
Okay. Let's shift briefly to the issue of capacity. And Everest, how do you figure what the level of your capacity in a specialist strategy is, and how do you divvy up that capacity? If you have one investor like Thomas that would come and say, I want the ability to allocate to you $50 million, but you know that your capacity is only 75. What kind of thought process do you go through in terms of the concentration you want from any one investor, and what do you think your capacity is, for instance?
So in that case, that capacity would be probably close to $400 or $500 million without material deterioration in performance. The idea there is that natural gas is the largest, second largest energy market in the US, and I trade the most liquid part of the market. So in that sense, I probably am not that capacity constrained, but in terms of how much do you allocate to a seed investor, you want the flexibility to, on one hand, you want the flexibility to have some diversification in terms of investor base, but then also depending on what kind of relationship you can have with the seed investor, you can allocate a larger part of that capacity to one investor with the idea that they're a longer term commitment to you and provides more stability. And there's a, like Thomas was talking before, there's the idea that once you reach 100 million, it's easier to raise more capital. So you could allocate 100 million to one or two seed investors or first investors, and then keep the rest to diversify later on. So
okay,
that's a good point. May I add here
sure.
something? In my opinion, actually, every hedge fund strategy has a certain capacity limit. Obviously, it can be lower or higher. For example, a microcap equity hedge manager might have a very low capacity limit, and I don't know, a futures trader might have a very high capacity limit. But even there is a certain capacity limit, because even there, although deemed as completely liquid, there is some slippage in the mark, and there is some leakage of information about trading strategies which could be exploited by others. So I think there is a capacity limit, and it's important to build an independent view on the capacity limit for every investor, rather than following just the numbers the fund managers give, or which are typically portrayed in the media. So you really have to make up your own mind when looking at capacity. But without any doubt, there is a capacity limit for every strategy, which is typically underestimated and is one of the major performance drivers, because once a fund has reached its capacity limit, in particular for specialist managers, the returns will no longer be as good. At least it will no longer be as much alpha as before. Maybe in the best case, at least a little bit of beta remaining.
Yeah. I mean, it's a key issue, particularly in some of these specialized commodity sectors. If we have somebody who's trading livestock, for instance, we may know that the capacity is somewhere between 50 and 75 million. But for us to be an allocator, and you Thomas and Bernie, you have both have the same issues that we do, is that if the manager becomes successful, and you obviously want to allocate successful managers, the capacity can fill up quickly. So we try to get in early, as early as we can, strike our deal, get some capacity for the future, and then hope the manager actually will not exceed the capacity when he gets there. It's always interesting to see that target keeps moving when they get close to the target. Bernie, how do you handle this in both as a manager? What kind of capacity you see for the agricultural strategy that you trade, and how would you allocate that capacity? And from the multi-manager side, do you try to get capacity agreements when you allocate?
Well, there's a couple of things. Thomas made a really good point, is that a lot of times what people can do when you're in a smaller area, if you're a higher velocity trader and you hit your capacity, people can see what you might be doing. And the degradation of returns is a function of how frequently your trade velocity is. So that's something that we always need to consider. The other thing I think that's important regarding capacity is you can allocate to someone, but you have to define how long does it take for that person to get out of trade of a portfolio. Say, for example, you're saying, okay, I don't want to do this guy anymore, or I don't want to do this individual anymore. How long does it take for him to exit his position? And what's the cost of that exit of a position? So from that perspective, I think that capacity is really important. From the manager side, is you're really taking a bet. If you're taking a bet because you're given all your capacity and your AUM goes up a lot, and it doesn't stay up because of some issues that go on with trading or whatever, that has a history to you. That attaches a history to you. So you have to really watch it. Everyone loves to have like a lot of investors where you got a lot of legs under you, so that in conditions where the market does something, the global markets do something. Say, for example, we had February, March of this year, or we had 2008, where we have liquidation that goes on and it impacts a smaller manager. He's got to be able to explain how he's done it, why he's lost his capital. Did he lose his capital because his investors needed liquidity, or did he lose his capital because he didn't really achieve his objectives in terms of what he and his investor thought? So I think those are important things to think about.
Okay. Well, we have, let's see, about 9 minutes left in our allocated slot. Thomas, what do you think are, let's talk about the outlook here. What do you think are some of the most interesting specialist strategies that you've been, from the universe of ones that you're looking at? Where are you finding your level of interest?
It's a very good question. I'm always asked by clients. Actually, I see two trends. One is more general in nature, and the other one is a little bit more specific. So let me begin with the more general in nature. What we have seen over the last couple of months or years, and it's not just Corona related, I think it's that just generally geopolitical and global macro considerations and decision makers have taken over. And it seems that the fundamental data does no longer matter as much as it has done before. So in our opinion, Corona itself, but also the general situation of central banks taking over when it comes to guarding the or directing the markets. It seems that geopolitical considerations should be taken first rather than fundamental data. So in our opinion, it's a general shift from, say, less flexible fund with one strategy, and I might contradict myself here because it's obviously not the niche expert players, but what we currently do is we shift a little bit more from those funds having one single strategy to multi-strategy funds, because they're just able to act more flexible in the market, which we as a fund allocator in the offshore space just cannot do, because we just cannot exploit intra-month market movement or opportunities. So having a multi-strategy fund, maybe within a certain space, in the relative value space or in the event-driven space, might be very viable here in this situation, because current opportunities can be exploited further. The second point is more specific, and this has to do with spread trading, and in particular with convertible arbitrage. Obviously, we, as many others, have seen this huge opportunity in convertible arbitrage, and I think this is not yet over. Convertible arbitrage is still a very attractive asymmetric strategy we are still allocating to, and this is not just because of the classical convertible arbitrage, but it's also because of this current mega trend of SPACs, so special purpose in acquisition vehicles, more or less replacing the standard IPO nowadays, which I do not want to go too much into detail, have a large asymmetry in their potential returns, and I think this is and will be exploited in future. So to sum it up, one is shift to multi-strategy funds in the offshore space because of higher flexibility, and the second thing is spread trading, merger arbitrage, but in particular convertible arbitrage with all its sub-strategies.
Okay, thank you. Actually, your comments resonate well with the way we see it as well, although we're focused entirely on the commodity sector. What's happening in that area is that the normal or historical level of volatility has returned to the markets, as opposed to what was happening during most of the QE period. And well, although there still is a lot of macro trends in and out, high, risk on, risk off going on with a number of the other traditional markets. In the commodity sector, and Everest, I'd be interested in your comments. It does seem that the fundamentals are more important now in driving the individual commodity markets. And as a multi-strategy fund ourselves, we can move the allocations around so that if we see the opportunity set in cotton better than what's happening in grains, we can make those allocation shifts. And because we know for sure that in many of these markets, there'll be long periods where nothing is happening. And you don't want your money just sitting around. But with managed accounts, you have a lot of flexibility. Everest, how about in the natural gas sector? Are you seeing the opportunity set attractive at this point?
Yes.
Obviously, that depends a lot on whether we have a cold winter or not. But
yes, so I think the volatility in natural gas has returned and is about to come back to the good old days of just a few years ago, actually. But the last couple of years were a little bit more mild in terms of volatility, even though mild for natural gas would be considered extremely volatile for almost any other asset class. But as we are seeing right now, for example, there's a congestion issue or potential congestion issue going on, and the front spreads have been moving 10% a day on a daily basis for almost 2 weeks. And we're going into a winter, like you said, that if it's cold, it could be a big problem. And same thing, if it's warm, it could also be a big problem. And that's because the supply and demand balance has been affected by the coronavirus, but the fact that the demand effect came in almost immediately because the government shut down, and the supply side of that response takes a while. There is a mismatch in terms of timing. So while we did take the demand hit right away in March and April, now we're still working out the supply side of it, and I don't think we're going to be able to fix that before winter is over, and winter brings its own volatility related to weather, which would be either way, it just adds more instability to the market. And
okay. Good, thanks. I see James is poking his nose into our panel here. We probably have a couple of minutes left. I don't know if there's any particular questions out there, but if not,
yeah, Mike, I wanted to pose one question from one of the audience members, and it's: do you have any opinion on A, music royalty portfolios, and B, life settlement portfolios? Tom, you want to take that since you might be the broadest mandate guy here?
Yes. Yes, but I probably will not give an answer which is satisfying to you, because this obviously is not my specialist area. I've heard about this investment opportunity, and I know that there are some funds running around there trying to sell it. I've once listened to that story, and I really can only answer superficially. And to me, it sounded as a relatively good opportunity, but the fund structure which was offered to us was just too illiquid. And I think this dimension of illiquidity has to be considered in this regard. And for us, it was too illiquid given the risk-return profile of the fund. Otherwise, for people being able to take an extreme illiquidity, I think this is an attractive opportunity.
Okay. We have a minute left. Bernie, just tell us, how do you overcome the challenge of trying to get allocators to pay attention to you when you're such a specialist? How do you find them? You use third-party marketers, networking? What's the key problem for a small manager that's trying to get recognized?
Yeah, that's
obviously
the $64 million
panel. That would be a one good thing.
Right. If I had the answer to that, that'd be great. How about all of the above, Mike? So, you know, it's, I don't want to say it's a shotgun approach, but there's no easy place to go. And sometimes you can find high net worth investors in a capacity constrained space that would be really great, that have some patience. Some of them don't have patience. So there's so many different ways to go, and you just got to kind of knock on doors and see what happens. So the positive attitude just like leads the way through.
And my message to many smaller managers, that don't get frustrated in the process, because what you find, you know, maybe the case with Thomas, or when I was running the allocations for Silvercrest as a wealth manager, the allocator may have his own specialized area of focus at the moment. And, you know, if he's looking for somebody in convertible arbitrage and you come in with commodities, the fact that he doesn't want to talk to you is not a negative for you. It's just that's not his area of attention. So a lot of these allocators are looking for specific solutions. So don't be frustrated by you know, the fact that people don't answer. You have to just keep at it.